All right, guys, let's get started. This is Prashant Kumar. I am from Cashflow Champs. I am a CCIM, certified commercial investment member. And we at Cashflow Champs are helping investors gain financial freedom through passive investments in real estate. Today, we're going to talk about understanding lenders' term sheets. So let's get started. Okay, just a little bit about me is I'm not an attorney. I'm a CCIM, financial advisor. I'm not a financial advisor. This webinar is only for information purposes. Please seek professional advice from appropriate personnel. Okay, we are helping investors gain financial freedoms. We want to impart knowledge. Hopefully, this webinar is very helpful for you in your future investments. And potentially we can share some investment opportunities also with you. But other than that, it's only for the information purposes. Just a little bit more. I'm married, 2 kids. I live in Long Island. I'm managing partner in Cashflow Champs. I've been a consultant in multinational companies for more than 25 years. Our team portfolio is about $146 million. We have about 1,650 doors. I do host Cashflow Champs Real Estate Podcast. I personally had about 2,000 units in my personal portfolio. I have about 1,000 units right now. I love helping others. I love multifamily and assisted living spaces. I meditate regularly and I help others to meditate as well. If you guys want to connect with us, schedule a call with us. The left QR code. We have free underwriting sessions on Saturdays, 4 p.m. Eastern. The middle QR code, no obligation at all. Every Saturday, 4 p.m. We do underwriting sessions, how to underwrite multifamily deals. And if you guys want to know a little bit more, want to become the part of Inner Circle, we do have some coaching, and basically we guarantee that you will become part of a deal within 1 year. Otherwise, we will continue to coach you for as long as it takes for free. So that's the third QR code. So take a screenshot, scan it later, whatever works with you. Let's jump on to today's topic. So we're going to talk about various sources of debt available for multifamily investors. What are the term sheets and the various nuances in the term sheets? How do we negotiate debt terms and we maintain our relationships with lenders and brokers? Okay, so let's talk about that. Let's start talking. So what are the sources of debts for multifamily, right? You have FHA loan. These are government agency, right? Up to 4 units. But if you go into more than 4 units, then you need commercial U.S. government agencies, which are Freddie and Fannie. Freddie and Fannie are not the lenders. They only guarantee the loan, right? Lenders could be Arbor or any other lender, basically. There are 100 lenders or thousands of lenders out there. But Freddie and Fannie are the U.S. government agencies who will guarantee the loan. Their criteria are pretty strict. They look for debt service coverage ratio of greater than 1.25 and at least 80% occupancy. The property has to be cash flowing. Without that, they won't give you the loan. Then you have CMBS loan. Commercial mortgage-backed security. These are fixed term loan, with some prepayment penalties, so you have U.S. government agency loans, CMBS loans. If your occupancy is less than 75, then you are probably going to go into bridge lending, where you probably will be paying higher interest rate. 100% of capex can be given to you, and some of them are non-recourse also. Fourth option is your local banks, credit unions, short-term 3-year, long-term 10-year recourse loans, which you can achieve depending on the property. There are a lot of local banks and credit unions, which try to give you the loan on a smaller assets. I have yet to see a credit union giving a loan more than $15 to $20 million. They're sub $15 million range. Then you have private money. I mean, if your property is not the right fit for any of these, then you have to go to private money or hard money, where you're talking about high vacancies, high upfront cost, bad credit area, but with a realistic exit strategy, right? So you can go for private money or hard money loan. In addition to that, you have promissory notes. You can go to SBA loans, which are very difficult to obtain. SBA has, SBA and USDA are US government programs. They guarantee the loan. SBA limit is up to 5 million for individual. USDA loans could be more than 5 million. They could go up to 10 or whatever, 15 million. But they are very difficult to get. They need to be a very strict underwriting. They need to be approved by USDA lenders. We have gone through SBA loans and USDA loans in past. It has taken us as much as a year to get the USDA loan approved. So I can talk all day long about these loans. Basic idea I wanted to give you: what are the different kind of loans available. Construction loans, then you have seller financing, and you can do seller financing. You can do master lease, buy with equity with title. Seller gets the mortgage and buyer has the option to buy at predefined value. So there are various sources of debt for multifamily. Let's see. We wanted to discuss the term sheet from a lender, right? So from logistics purposes, put your questions in that Q&A box, and I will take them as we go along. So what happens, when you are looking at a property, you probably will go to a broker, and broker will give you some indication. Typically these brokers, lending brokers have connections with a lot of lenders, and they underwrite the deal. And after that, they give you certain options. Remember that they may give you indications of what is going on in the market, right? And it may just be their own interpretation. They have not gone out to the lenders yet. I mean, we call it pre-term sheet indications from lender, right? If you go to, I'm just showing something from one of our properties in past, actually long ago, about 2 years ago. So if the broker gives you some indication, means broker knows that these are the different lenders, and we can potentially get these different terms from these lenders. And now it has to make sense to our business plan. So in this scenario, this is for one of the properties that we got indicative quotes from a broker with initial LTV of 70 to 75% loan to value, right? So, and the future funding is, it was a bridge loan, basically. The occupancy of the property was less than 80%. So we had to go for the bridge loan because we wanted to improve the vacancy of this. We wanted to improve the asset. It was a value add deal, basically, for us. So these bridge lenders, even though their interest rates are higher, they try to give you 100% of capex. That way they want you to succeed, because for them to be successful, we have to be successful. So their sole term, they underwrite that deal. They say, listen, we are going to give you 70 to 75% LTV. We'll give you all the capex. Our terms are only for 5 years, 3 years. The loan term is 3 years with possible extension, 2 possible extensions. So initially they may give you interest only, years of IO, full term is 3 years of interest only, but additional years could be amortized over a period of time. So everything is not so black and white. They are typically gray in these indications. from a broker, right? And again, the index 2 years ago so far was 0.1, which is like 4.75 today. So that's eight point two to 8.7 in that range, right? So this is an indication from a broker, right? Broker says that if you go into this property, I can get you, full-term IO, where you are just paying the interest, not the principal, for at least first 3 years, and then basically there are possibility of 2 more years, so you can potentially have that bridge lending for 5 years, basically. So this is an indication, and for basically these lenders want to have the minimum stable debt yield. They underwrite it. They say that, okay, this property rent is 700 now, but it will be 800 once you stabilize it. They want to make sure that their debt is making at least this much money, right? So that's basically debt yield they underwrite for. And the recourse part is basically, as it says, that some lenders are recourse. Most of the bridge lenders are recourse, okay? And some of them could be non-recourse also. The difference between recourse and non-recourse is that the non-recourse lender can take the property from you, but they probably will not come after your personal assets. But a recourse loan, meaning they will take the property and they will sell it, and if it doesn't meet their debt, they will come after your personal assets. So your non-recourse could be converted into recourse if the bad boy clause is activated, means gross negligence. You have neglected the property and you have done fishy things on the property. Then that non-recourse that bad boy clause gets activated, and then that non-recourse loan gets converted into a recourse, meaning that lender can sell the property, and lender can take away the property, sell it in the market, and if they don't get enough money for the property, they will come after your personal assets. So again, this is an indicative quote, and it means that, yes, based on this indicative quote, you would go and underwrite your deal, right? You would underwrite a deal, you will sign the PSA, and then you will go, ask for a real term sheet from the lender, meaning that the broker would go out to these lenders with a more firm PSA signed approach, and they will try to get some term sheet in a written form. And remember that indicative quotes and or term sheets from the lender are not final. These are not final. These are not final commitments for the loan. These are only number one, from the broker, number two, from the lender, that yes, lender is interested in giving you the loan for this property, right? So once lender underwrites, then lender issues the commitment, and we'll talk about that in subsequent slides, but feel free to ask any questions. So I'm just sharing, let's look at one of the term sheets, from a lender, right? So you have gone through the broker, you have given your underwriting to the broker. Broker has underwritten the deal. Broker has taken it to the lender. Lender comes back, tells you that these are the terms. This is my term sheet. I want, obviously, proposed guarantor. They want to see who is the guarantor. So it is everything is subject to satisfactory lender review for financial statements. Lender will review the guarantor's financial statements. They will say that, non-recourse with standard carve-out. standard carve-out is, which I said, bad bar clause, plus few other clauses. We don't have to go into details that much. Guarantee, obviously, guarantee of completion of the project. That is the guarantee that loan guarantor is taking, and then environmental indemnity. Loan purpose, acquisition and lease up of the property. It's a bridge lending term sheet. So what they are saying, you will acquire it and you will lease it up to a certain level. Basically, that's the purpose of the loan. Initial loan amount, they say, they look at and they say this much amount, this is the initial cost, and they want to go for lesser of certain things, right? Lesser of 73% of the initial cost, or 13 million, or 75% of as is appraised value. So lender just is putting their loan amount that I'm going to give you the least of these three scenarios, basically, and in place debt yield of at least 5.5% in this scenario, right? And they will fund 100% of the capex, which is about $1 million in this scenario. That means some capex reserve and some advanced working capital to begin with. So total proposed commitment is basically the sum of initial loan amount and the future loan amount. And basically, lender's term sheet have many other things. Future funding structure. 100% of working capex advance will be funded and released to the borrower at the closing. In addition, 25% of the capex reserves will be funded into a lender-controlled account at closing. So lender wants to control the capex. Lender is not going to give you the whole capex money. They will give you some advance, but then they will put 25% of that into a lender-controlled amount at closing. The remaining proceeds will be funded into lender's control account by month 24 of the loan term unless needed earlier. So lender writes all the terms. They want the guarantors and investments from other investors. So that is minimum equity that they need if they are issuing $14 million, they are asking us to put in about $5 million from the sponsor group. Again, the interest rate written here is 3.75% spread over 1 month SOFR. The SOFR 2 years ago was 0.1, to date is 4.75. You can sum it up, how much should be the interest rate. They give you the loan terms, 36 months, and extension options, 2 extension options. And extensions are not free. I mean, extension needs, they will take some deposit, and there are some extension conditions. No prior payments of default or material adverse effect during the initial loan term. Payment of the extension fees. Fees is typically 1%. Maximum LTV of 70%, subject to updated lender engaged valuation. Lender does the valuation of the property after initial loan term. Minimum occupancy, 90%. Minimum debt yield of 8%. So they have so many requirements to extend the current loan for another year or two, right? So first 36 months for interest only. After that, any extension would be amortized over 30-year period, right? Prepayment terms. Some lenders have prepayment penalties. Sometimes they do, sometimes they don't. Remember, these things can be negotiated with the lender, right? Lenders wants to make money, and they have their own underwriting. But if you are a good borrower with a good history, lenders try to work with you, and you can negotiate some of these terms. It is not fixed, set in stone. So all these can be, like interest rate cap. Most of these lenders want interest rate cap, right? I mean, if the SOFR is keep on going up from 4.75, I mean today is 4.75, it keeps on going up. your interest rate could be going through the roof, basically. So the idea is that most of these lenders want rate cap insurance. Rate cap is an insurance on the higher, what is the maximum interest rate that property can support. You buy that insurance, and if the interest of the property goes beyond that number, then you get the money from the insurance company. There are a lot of them out there, but so then exit fees and extension fees. So these are terms after terms on these lending term sheets. Hopefully it is making sense. If there are any questions, please let me know. And they have special conditions. They want to have subject to minimum in place debt yield, occupancy of 9%, subject to review the sponsor capex plan. So they look at each and everything, detailed timeline, itemized budgets, drawing permits, subject to confirmation of a sponsor security contribution, minimum 5% GP equity from the borrower, net of fees. So they write all the terms, basically, and they tell you, they give you the term sheet, and they say, listen, if you are interested in it, sign it by this date. That's the expiration of the terms. And I mean, this is a very detailed term sheet. Sometimes some lenders have 3-page term sheets. Sometimes they may have 30-page term sheets. I have seen it both ways. They look at, in this case, they are even giving what is going to be our initial sources and usage, right? My initial purchase is this much. My closing cost is this much. This is my total use, right? What is the source? Sources, initial loan, and equity to close. Similarly, for future uses, this is the capex, and this is the working capex in advance. And sources is coming from the lender, basically. So they try to put everything together at one place. And this is a term sheet. You would sign it at the bottom, you'll send it back, and that's when your proceedings with the lenders will start, basically. So what really happens is, bank really needs some deposit before they start working on the loan file. They may give you a term sheet, which is their typical way of showing that, yes, they are interested. But if you really want, you like it, you sign it, then they want some deposit from you, right? So bank needs all these financials for the property. They want trailing T12, they want the rent roll, they want the offering memorandum, right? They underwrite the property, they underwrite the borrower, who are the guarantors. So they look at all your financials, they look at your bank statements, they look at your schedule of real estate owned. And once that is done, basically they have underwritten the property, they have underwritten the borrower. Then they start spending money. When I say they start spending money, means they start ordering appraisal and they start ordering environmental, basically. They do not spend money until they are sure that properties that they can live up with, and the borrowers are the ones who can live up with. I mean, it depends on the lender, but typically that's how it goes. So they order appraisals, they order inspection, they order environmental, termite, title, and they keep on underwriting the deal. They keep on looking at the deal with a fine comb, and then once the package has been put together, the package goes to the loan committee for the approval. And once the loan committee has reviewed, they do the approval, then you are free to close. So you have gone 30 to 60 days worth of work with the lender before the deal is even presented to the loan committee, right? All the analysis work by the lender, by you, is done up front. And then that package, that the analysts take that package to the loan committee based on their terms. Loan committee approves it, and then you go towards closing. Hopefully this makes sense to all of you. Obviously, you want to look at the properties which are 80 to 85% occupied or more with DSCR greater than 1.25. It is not 12.25, it's 1.25. You want to see what is the rehab cost, what is the upside, and what is the experience. We typically ask you not to jump into bigger project. Take one step at a time, because if you make mistakes, these mistakes could be very, very costly. So coming back, I think that's all I had. If there are any questions, I would like to take them in the Q&A box. But in addition to what I explained, that we are cash flow champs, right? And we have underwriting sessions for our wannabe syndicators. We have inner circle, and we have, obviously, if you want to connect with us, we definitely want to talk to you more. But besides all this, we have a deal in Atlanta, and you can scan this cashflowchamps.com/invest now. What it is basically 236 unit apartment complex, where the debt rate is extremely lucrative, 3.48%. So let me share, and the projected rate of return is about 17% IRR, low 3.48% interest rate. Number one, low interest rate. Number two, properties completely rehabbed inside. And number three, the rents are about $200 below market in Atlanta, Decatur market. So we have that deal. We are 80% subscribed. If anybody wants to join, and go to cashflowchamps.com/invest now. That will help. That will give you at least how we are doing the business. I'm not saying that, I'm not pitching it here, but you want to just have a look at it, how syndicators are doing it, what is there in the market. And if you are a busy professional, we would love to have you with us. Would love to have you invest with us. And it's all electronic. It's open for accredited investors only. If you're not accredited investors, unfortunately, you cannot invest in this. This is a slam dunk deal. I mean, it has been you don't find a deal like this for a long, long time. I mean, it took us 6 months to get this deal. 236 units apartment complex in Decatur, Georgia, $32 million acquisition. The cash on cash is about 8 to 9% from day one. From day one, the average cash on cash is about 8 to 9%. So it's a cash flowing deal, basically, with an upside. So overall, you double the money in 5 years. In 5 years, passive investors double their money, basically, including the cash flow that we get during the 5-year period. If you want to know more about this deal, go to cashflowchamps.com/invest now. That's all I have for today. I appreciate your time. Please feel free to connect with us on cashflowchamps.com, and we'll talk next time. Thank you so much. Bye now.